So let's listen to.
Hey everyone, and welcome. So, today we are tackling what is maybe the toughest part of investing. It's not about what to buy, it's about when to sell. This is the place where pure, raw emotion can just absolutely destroy even the most well thought out portfolio. We're going to break down a really powerful, rules based framework from SATF that honestly takes all that guesswork out of selling. So, let's dive right in. I mean, this is the $1 million question, right? It's what keeps investors up at night. Do you sell when a stock is flying high to lock in those profits? Or do you sell when it's tanking to cut your losses? Maybe you just hold on and hope for the best? Look, this single decision can be completely paralyzing. And you know what? Getting it wrong is incredibly costly. And that right there, that quote, absolutely nails it. Anyone can get lucky with a hot stock pick. That's one thing. But the investors who really deliver consistent, long term results, they have something else. They have a clear, unemotional strategy for when to get out of a position. Simply put, they have a plan. So, how do you actually build that plan? Well, the secret is having a framework in place before you ever need it. You want a set of rules that takes your gut feelings, your fear, and your greed completely out of the equation. And that is exactly what this SADIF framework gives you, a clear, logical process for making smart selling decisions every single time. Okay, let's get into the first rule. And honestly, this might be the most important one of all. This rule is all about playing defense. It's about protecting your hard earned capital so that you can live to invest another day. Now, before we get to the actual rule, we got to understand one key idea. RTM. That stands for return to market ratio. It sounds complicated, but it's actually a really simple, powerful concept. Instead of just looking at your stock's price, RTM compares how it's doing against the overall market, say the S&P 500. So if the market goes up 10% and your stock also goes up 10%, its RTM is 100. It's performing perfectly in line with the market. Makes sense, right? And here's where the rubber meets the road. This rule gives you a hard, non-negotiable trigger to sell. If your stock's RTM drops down to 70, which means it's underperforming the market by 30%, you sell. That's it. No questions asked. No, oh, I'll just wait and hope it bounces back. It is an automatic, emotion-free exit. So why be so ruthless about it? Well, because a 30% underperformance against the market is a massive red flag. This rule is specifically designed to stop you from riding a dying stock all the way to the bottom. It forces you to cut the dead weight from your portfolio so you can take that capital and put it into something that actually has a chance to grow. Okay, quick pop quiz just to make sure this is locked in. What was that RTM number for an automatic get out now sell? Yep, 70. If that RTM hits 70, you are out. Simple, clear, and disciplined. All right, now for a much happier problem. What do you do when a stock is just doing incredibly well? I mean, it's so tempting to just let your winners run forever, but that can actually be just as risky as holding on to your losers for too long. Rule 2 is a really smart two-step process. So, step 1, your stock has to be a certified high flyer. Its RTM has to go above 130, meaning it's crushing the market by more than 30%. Okay, once it hits that level, you start watching it like a hawk. Step 2 is the sell trigger. You sell if it drops 10 points from its highest RTM. So, for example, let's say it peaks at an RTM of 150. Your sell signal is a drop to 140. And the thinking here is just brilliant. Look, the goal is not to perfectly time the top, because let's be real, that's impossible. The goal is to let your winner run, but have an automatic plan in place to get out and lock in the vast majority of those gains once its momentum starts to fade. It's all about protecting your profits. Okay, so we've covered the big losers and the huge winners, but what about all those stocks just sitting in the middle? You know the ones, they're not really doing much of anything. Well, Rule 3 tackles this part of your portfolio that we all tend to neglect. This rule is all about active management and something called opportunity cost. It forces you to ask a really important question. Even if this stock isn't losing me money, is it the best place for my capital to be right now? Could this money be working harder for me somewhere else? This rule pushes you to regularly review these flatliners and actively decide if they still deserve a spot in your portfolio or if it's finally time to reallocate. Okay, so you've got the 3 core rules down. But there's one more layer to think about, especially if you have winning stocks in a taxable account. Ah, taxes. The number one reason so many of us hold on to a winning stock for way, way too long. The fear of handing over a big chunk of your gains to the taxman can create this lock-in effect where you end up making a bad investment decision just to avoid a tax bill. So how do you get past this? Well, the framework gives you a way to turn this emotional problem into a simple math problem. It helps you calculate a break-even point. Essentially, it answers the question, how much would this stock have to fall in the future to completely wipe out the money I'd pay in taxes today? Once you see that number, if you think there's a real risk of the stock falling that much, it makes the decision to sell now and just pay the tax much, much easier. All right, we've covered a ton of ground here. We've talked about cutting your losses, securing your wins, and reevaluating those stocks that are just stuck in neutral. Let's pull it all together into one simple, powerful framework. And here it is, your 3-step selling plan. Step 1, cut your losses. You immediately sell any position if its RTM falls below 70. Step 2, secure your wins. Once a stock's RTM gets above 130, you sell if it dips 10 points from its peak. And finally, step 3, review the rest. Don't forget the middle. Regularly look at your stagnant stocks and ask yourself if your money could be working harder somewhere else. And that really brings us to our final thought for today. As you look at your own portfolio, I want you to ask yourself this question. Are your decisions to buy, hold, or sell driven by a clear plan, like the one we just talked about? Or are they driven by the daily noise of the market, by fear, and by greed? Because having a framework like this isn't just about trying to get better returns, it's about getting better peace of mind.
Okay, so let's go back again to our presentation and try to understand why Sadif is suggesting that we should be ruled by rules rather than by discretion. Okay, it's not exactly that, so we should always allow some room for discretion, but it's important that we conduct our investments always based or mostly based on rules, with the occasional exception, of course, but not too many exceptions, right? So that's the basic philosophy of Sadif. That's our basic philosophy, and that's why we decide to introduce these rules, which we call Sadif rules, exactly to highlight those that philosophy. And if I'm going back to the start of this presentation, just to okay. And what are these three rules that were actually mentioned in the stock in the short video? Okay, rule number one, and this is really the most binding rule that we should only violate in very rare circumstances, is that we should not allow a stock to lose more than 30% relative to market. How did we calculate this 30%? It's just because of the time of the amount of recovery that it's required to offset just the loss. So you have here on the chart on the side, on this chart on the right, you need that 30% loss requires a huge gain just to break even. It's not to make money, it's just to break even. It requires a 40%. That is quite a bit. But if you going to look at 50% loss, for instance, let's say you're going to be generous, you want to go, then the required recovery would be 100%. So it is huge. So there's a limit that you need to set. Now you ask me, but guys, you had a red alert for Microsoft, and you haven't yet closed the position in your tips portfolio. So how come? Well, as I told you before, because we sort of delayed our reaction, and we made a big mistake, and which we should correct as soon as possible. It will be correct as immediately once we are going to add new peaks to our list. We are going to do that, Um, and the reason why we can sometimes wait a little bit is that this if a stock is very volatile, it will come. It may be one day losing 5%, recovering another 5% the next day. So this red alert may disappear, and usually, typically, we uh, advise people to at least wait a couple of days, maybe a week, to see if the red alert is still on, or if it has disappeared. If the red alert is still on, then you should have no contemplation and close the position immediately. So, but this, as I was saying, is probably the most important rule that we consider the investor that wants to perform well in the long term is the most important rule. Okay, what else should we consider is the yellow rules. You know why we should look at the green. Let me go back to the. Let's still go to the second rule, which should be. I think it's not called here. The okay, not this one. Okay, the third rule that, and then we'll go back to the second rule about the profit taking. The third rule is that we have to be aware of the cost of stagnation. If we have stocks that don't move, they stay stagnant for a long time, whether slightly positive or slightly negative, this is not a sustainable position because it has a cost. And what is the cost of that? Is the opportunity cost that we could be investing in new stocks. Let's say if we have, for instance, 10 stocks in this interval. Let's say if we have 10 or 20 stocks here, so they are costing us money because they are not allowing us to find new winners. Of course, if we close these 20, let's say if we have 20 stocks here, if we close them, probably only five or so will fall in the winners category. Some of the new stocks will probably also fall into this category, and some will fall on the losers category, right? But the fact that we were waiting too much, too long to take a decision meant that we lost the opportunity of having these big winners, and then of course shuffling the ones that fall within this so-called gray area, which we don't know if they are moving up or down. So that's why it is important. Whether we do it, as we suggest, once a year, but of course you can, if you prefer, you can do it twice a year. You can do this evaluation twice a year, not too frequently. That I wouldn't say that you do this every month. For it, that would be then because then you run the risk of becoming a high frequency trader rather than a long-term investor. So we're always very careful to preserve your style as a long-term investor. So try to avoid doing that too much. And of course, it depends on the nature of your stocks. If they are value stocks or if they are growth stocks. If it's a value stock strategy you are pursuing, of course, you have to give more time to see if the stock exits this narrow band. If it is a growth stock, you would expect it to exit the narrow band faster, and so you also have to take into account the kind of stocks you have in your portfolio. So you have to take that into account. Okay, let's go back again then to our platform, which must be here, and let's look at the big winners. We're not going to the big win, not this. Sorry, I have to go here. Okay. So here as I already told you, we have two types of alerts. You have a red alert when a stock which was above 130 suddenly declines about in terms of its alpha, declines to just 90% of its peak, and then we need to look at into that. And that's a case like the one here. So this stock at one stage was 300%, more than 300%. It was three times the market return, but it's now double. It's still double, and of course we got an alert for that, but we haven't sold this immediately. So why didn't we sell this immediately? Because we also need to bear into account what we called here the break-even analysis based on the cost on the based on the taxation cost of closing your positions relative to potential market decline. Just a second, I need to close here something. Gosh, I can. Okay. So what we need to enter here is that little equation that we had there in our in the video, which is we have to find we need to find the balance between a potential continuing fall of the stock and the cost, the taxation cost that if you're going to close the position prematurely. Okay, so this break even that we define here, call here as D, is calculated as actually I'm not using exactly the same as the level of taxation, the tax rate times the price change that we fear will happen. So the price decline that we fear by that will happen. So let's give a numerical example because it is easier with taking into account this specific company. So as you see, the company, where, let's say it's, for instance, a Portuguese investor or someone who is in a country that where the tax rate is 30%, the capital gains is 30%. So the T is T, and the fear of a further fall depends on the gain that the stock has reached, and here we know that the relative rate relative to the market, R is 2. Okay, so with this kind of number, what we have here, you have that the break-even would be the break-even position of this would be then 0.3 times 2 divided 1 by 2, which means that it will be I think I have something wrong here. Oh no, that's fine. It's fine. So I would have here 1.3 times 2 divided by 3, or I would have 0.6 divided by 3, which is now I need my calculator before I make a mistake. Oops. Okay, just trying to be fast. Okay, so I have 0. 0.6 divided by 3. So this gives me 0.2. Actually, I should have, I shouldn't need a, stupid of me. I shouldn't need a calculator for this because it's too, it should be immediately. Anyway, sometimes when we are talking, we make these huge mistakes. So let's see that then. What is my D then? The decline, the expected decline in the market that will offset a tax rate of 30% will be 20%. So it means that for this stock, the decision, the break-even between the tax cost and the decline in the market would be 20%. So for a 30% tax rate, and the stock which has already earned, it's already twice 200%, so which is 2 there. So the decline would be 20%. So I have to assess. That's how I need to assess. But imagine that I was in a country with if I was in a country where the tax rate would be 50%, for instance, then of course this would increase to 1/3 or 33%. So if the tax rate would be 50%, if I was an investor in a country where the tax rate would be, capital gains tax rate would be 50%, then my break-even decline would be 33%. So, and likewise, if it was less than 30%, the same thing. So that's why this is also a factor that we need to bear into account when deciding if it is, if from a tax-wise point of view, if it's reasonable to close the position and incur the tax cost. Of course, if we and that's important why a green alert is not an immediate indication that you should close your position and take the profit. You take your profit. It's not an immediate indication because you need to consider the tax implications, but it means that you need to consider the evolution of this alert. Is the alert continuous? It will continue for a long time. Is it disappearing? Does it come back? So how should I manage this? Again, if you go back to the previous session, the previous example, we need to look at the timing of this green alert. And one possibility is to see if this green turns yellow. I don't know if we have a yellow here. Well, we have a good example here, a yellow here. Okay, we have this yellow here for this company, APP, which is still winning 26%, but we got a yellow alert here. Why? Because the reduction of the price to market, the return to market at the peak, which was at 185%, has already fallen to 115%. So here, what is the limit that we introduce? It's not the the stock could be falling the 10% relative to the peak, and we would get here a green light, but would not act. But we have a strong recommendation to act when the decline goes below the 130. So in this case, the decline went below the 130. That was the limit that we set for a consolidation of a gain. So in this case, it's already 115. So it's a strong alert, which means that we should sell this stock unless we think that it's going to recover soon. Otherwise, we risk losing our gain, and we still have a substantial gain in this stock. But we should not let it go to the position where the return to market would be 100, which means that would basically replicate the market. If you want this win to be a win above the market, then we need to stop it. And as long as it goes below 130 here, then we should have a yellow alert here that lets us know that we should be really carrying out the due diligence to see whether we should really close this. Of course, if we're going to do this, we can also use the our break-even analysis here to see how much we can still look at, considered in here. Then we'll need to replace the 2 here by 115, which is it now, 115. So we'll replace it by 115 here, and see what the kind of price fall we could still cope with. But again, if you want to be conservative, as soon as you get the yellow alert, and if your position was a winning position, was on the top of your positions, then it's better if you are want to be a more risk-averse person to really close the position and take the profit. So that's the recommendation that we have. Okay, just remind again what is our. Oh, actually, we still have some issue that we need to recall, which is we have. Shall we include here also? You see, we have this 20%. That was our decline. But what if I want also to consider the risk of losing an upside? That let's say the stock, instead of falling, the stock is going to rise a little bit more and more. Let's say if we have an upside, then we should add the upside. So then we should add here, let's say, an upside plus this, which means that if I had a 20% here, if I expected there will be an upside of 10%, then I should increase this to 30%, because I will also lose the upside. That meanwhile the stock recovered and increased another 10% before falling off, then I should then look at have a more stringent limit on this balance. So again, we can also include in this analysis the possibility of an upside. And as I was saying, just to conclude, let's just remind you quickly of the list of tools that we have in our platform to examine this type of situations. And I think it's on page 12 here. So just to close, cut your losses, roll the maroon, lock profits, number 2, evaluate stagnant positions, number 3, and number 4, don't forget the tax implications. So these are the essential rules that you need to keep your profits. So to preserve your gains, these are the fundamental rules that you should always comply with. Okay, that's all for today. We'll be back tomorrow with a new session. Thank you very much for your attention, and see you tomorrow.